Hi, guys. Welcome to the How I Raise It podcast, the show where we get an inside, unfiltered look at how real entrepreneurs and investors raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Nik Talreja of Sydecar. Sydecar is a platform that helps investors and founders set up a special purpose vehicle or SPV. So, as you can guess, this episode goes deep into SPVs. What are they? Why you should care, etc. We get into how to set up an SPV to build a track record as an investor, how to use one to create an opportunity fund, the difference between an SPV and a syndicate, the use case for founders, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or FundingStack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool to help you get warm intros to those investors, a CRM to manage your fundraise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Nik.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Nik Talreja of Sydecar coming to us from Houston. How's your day going?
Going very well. Nice and hot.
Yeah, I bet Houston in the summer is a sight to behold. What's the temperature today?
I don't even know. It's probably in the 80s to 90s with it feels like about 10 degrees higher. But
Because of humidity? Or
yeah, absolutely.
yeah.
Yeah. If you go into the mindset of it feels like a vacation when you step outside, I think it's more tolerable. So that's what I try to do.
That's an interesting mental trick, I guess, if that works.
Yeah, sometimes.
Sometimes. Interesting. Very cool. Well, let's go right into it. What is Sydecar?
Yeah, Sidecar is a platform that I started about 4.5 years ago to enable venture capitalists to get in the business of deploying capital by removing all the pain points around structuring your first SPV to trial out your thesis of being a VC, starting your first fund, and just dealing with the headaches of forming entities, opening bank accounts, having to deal with tax advisors and fund accountants. We just figured, hey, we could distill away all that pain by building software to automate these very painful processes. And if we're able to standardize how they're done, we can also make them highly cost effective and approachable to GPs and LPs. So we're in the world of creating SPVs for venture capitalists, and we recently launched a product called Fund Plus that allows VCs to launch their first fund in a very formulaic, simplistic way to trial out a thesis for your fund one or fund two.
We will definitely touch on that in a few minutes. What were you doing before? Where were you working?
Before starting Sidecar, I had a glorious job as a corporate attorney, working at larger law firms before starting my own law firm. I worked in New York City in capital markets before moving to a firm called Cooley in Palo Alto, where I was at for a few years, and then I ended up starting my own law firm, and I represented a number of founders and VCs directly, which gave me a lot of exposure to great founders, and I actually had the passion of wanting to back those founders. And a co-founder of Sydecar and me, we actually launched a fund to back some founders directly that we loved working with. And that's what led to building Sydecar, was feeling that pain directly of building your first fund.
And that kind of segues to my next question. I was going to say, before Sydecar, how did people create SPVs? I assume it was just by hiring their attorney to draft it up, right? I mean, there wasn't really or you tell me.
Yeah, that might still be how many people, if not most people, form an SPVs, talk to an attorney and get the paperwork drafted. There were a couple of vendors that existed at the time Sydecar was born. AngelList has been around for a while. That was a part of their business. I think it still is. And there was another business that we actually tried to work with that no longer exists because their margins just didn't make sense, called Assure Fund Administration. So there were a couple of vendors, but no one was running a business of really automating all the back end processes in a stable, lucrative, high margin business type of way that still offered the value proposition of being extremely low cost to the VCs who wanted to launch their first SPV.
So look, we're going to get into real basic stuff, and we'll dig in a little bit more. But just for anyone who's not familiar, what is an SPV?
So the SPV stands for Special Purpose Vehicle. And when I think of the term in the world that I'm in at Sidecar, an SPV is the vehicle that someone might create to collect capital from a group of individuals who want to invest in something together. And then that vehicle basically acts as like the conduit for all that capital and all those individuals, and it represents all of them together in one entity that then invests in the asset. So today we serve primarily venture capitalists. So SPVs in our world are buying private company shares typically. So, an SPV will sit on a company cap that will represent all those investors in one vehicle.
Yeah, makes sense. Is it because I know like this goes back a ways, but people would sometimes form an LLC to pool capital, invest in something. Is it a standalone legal entity or what?
Right. So the entities we create, they're actually under this structure called a Series LLC in Delaware, where they're each treated like a separate entity, a separate company under the law. And practically speaking, yeah, they're exactly as you described.
Got it. Okay. Yeah, makes sense. And I guess, why would you create an SPV? You kind of mentioned that already, to pool a bunch of typically smaller checks into
Correct.
one line item on the cap table. Is that kind of the main attraction there?
That's right. So our customers involve folks like angel syndicates or emerging managers that are trying to build out a fund, perhaps, and trying to prove out a thesis for why they should raise a fund. So whether an angel syndicate or that emerging manager, if you're finding an interesting company to invest in, you're typically not going to ask the founder to take 30 or 40 individual checks from the people that you're raising money from, right? That would be kind of a tall order to put all that burden on them. And also that would make it very difficult for you to actually get the upside that you would want as the VC, right? As a person who's sourcing that deal in the form of carried interest. So you create an SPV to basically collect all of that capital that you are sourcing, attach your carried interest to any success at that vehicle level, and then move that money into the company you're investing in as a single line item. It basically handles all the logistics and the gymnastics of getting that capital to the right place.
Yeah. And I'm not that familiar with it, but I hear about it bounced around a bunch. One use case is I hear, if you want to become a venture capitalist and raise a venture capital fund, you need a track record. Maybe you work for a large fund and have a track record there, or maybe you've done some angel deals, have a bit of a track record. But one thing I hear about SPVs is a way to build a track record, which, you can do if you don't have actual capital to deploy. So maybe talk through that. I guess the question is, if I want to become a VC and I want to make a track record with SPVs, how would I do that?
Yeah, exactly as described, right? Like, why would someone use SPVs? It's exactly what you said. It's, hey, I want to raise a fund. And to raise a fund, a committed capital fund, LPs need to commit to you, right? And believe that you are going to do something differentiated over some period of time. And they get no say over exactly how you use that capital. Like, you have to follow your thesis, but beyond your thesis, you get to move that money into all the companies you want to invest in. They don't get to say yes or no to each individual asset, right? How do you get LPs to give you that money and basically that blank check to say, you know what, I trust your judgment. Nathan, I want you to run this fund. Here's some money. Take my money. Call it whenever you need it. You got to build that trust and that credibility, right? So a few ways to do it. One, work at a larger fund, build relationships with LPs and also with founders, right? And just walk out the door with commitments from those LPs. That is I would say, the unique example of success in this world. The more common trajectory is, hey, I'm going to start at the ground level. I'm going to start doing deals and meeting founders and helping them and get access to their cap table. I'll invest in them directly myself. And eventually I will ask people to join my journey. And I'll just prove I'm so good at finding great deals that people will they'll want me to be a VC. They'll want to give me more money to just go ahead and run this business. How do you get there? It's typically by trialing your thesis, by finding deals and offering it to LPs you might want to solicit for your fund someday. But now you're soliciting deal by deal to see, is there appetite for what I am doing? Can I build these relationships? Do people actually give me money? Where there's a lower risk for them because they know exactly where it's going. I'm going to give them an opportunity on a deal by deal basis. We find that SPVs are like a perfect way to trial out a strategy. Inevitably, everyone who runs SPVs, even after they raise their fund, they typically need SPVs because they find that it's typically easier to get more money from your LPs for a particular deal than it may be to get commitments to your fund because they have that agency. So it's a nice strategy to test out a thesis, but also just sustain a business model thereafter.
Yeah, really interesting. Let's use simple math, but economics of a deal. So I'm eager, want to be a VC. I have some interesting startups I'm talking to. Let's Is there what's sort of the average size SPV for an emerging manager, uh, guy or gal? Are they doing $1 million per SPV or more than
Yeah,
that? Yeah.
for an emerging manager, I would say it's probably in the 200K range, maybe 150 to 300, somewhere in that range.
Okay.
Um, it really varies by the category you're in and the types of deals you're investing in. What we're seeing right now is that some emerging managers are also engaging in secondary investing. So they may be finding folks who work at really, hot companies today, right? Could be like a Anthropic or, you name it, really hot AI business. There's just so much demand for those businesses that even if you're an emerging manager, you might be able to cobble together $1 million of interest in a company that is just like becoming a household name, right? Whereas like the true seed stage round for a company that people don't really know about, that you really have to sell hard on the merits of the founders that people don't know,
Yeah.
those rounds tend to be a bit smaller for an emerging manager.
Okay, so let's go through it a little bit more. So I'm going to get access to call it 300K allocation into the particular startup. I go out and, is there sort of a minimum check size most people do? Is it 25K and above? I'm wrangling all
Yeah,
these smaller checks. And then talk about the carry for the deal originator for me. How's that work?
sure. Good questions. Minimum check size, man, that really varies. There isn't like a rule there. I think everyone would love for it to be 25K, 50K, something to make your life easy. So let's say it's a 200K check, you have to go to talk to 10 people and you're done. In reality, it really varies, and most people accept checks that are smaller than that. Um, as far as deal economics, standard carry is 20%. It has been for as long as time, and it still generally rings true. It's just something people have accepted. It's like, all right, 20% is going to be carried. If it's a fund, 2 and 20 are just the economics, just like everyone has, it has a ring to it. It applies to SPVs also.
And so just talk about that. So on the 300K, does the deal originator, me, the emerging manager VC, have to invest to get the carry, or can I literally just wrangle 300K from my friends and family and get the carry? And then how does that carry work? Maybe give us a real
Yeah.
simple example. Yeah,
Yeah, I'll do my best to keep it simple.
I know.
So do you have to invest? No, right? There's no commitment to investing in a deal that you source and place and to get carry on that deal. Your carry is like your economic interest. It's like your share in the deal is like your carry if you don't invest. Practically speaking, if you invest, it makes a much stronger case for others to invest alongside you. So we find that in most deals that people really believe in, and like I'd be excited about investing in myself, like the GP usually puts in a small amount of money or some money if it's just a token, even just to say, hey, you know what, I'm putting some skin in the game here also. Oftentimes that's not required though for many deals that people are excited about just on the merits of the deal. As far as how carry works, carry works as follows. So let's say carry is 20%. What that typically means, because you can draft legal documents every which way, but what that typically means is, let's say the deal is like $100,000 and your carry is 20% on that deal. If the deal is successful and returns $100,000, that first $100,000 goes back to the LPs. So they get their money back. But then every dollar thereafter is split 20% to you as the GP, 80% to the LPs. So let's just use simple math and say it's $200,000 at exit. So maybe not a venture scale deal, but hey, people are making some money. Invested 100K, 20% return. A couple of years later, $200,000. 200K comes back. The first 100K goes right back to the LPs. The next 100K split 20K to the GP, 80K to the LPs.
Yep. Great. So, I mean, basically, it's a way to get 20% of profits after, paying back the investment. I know it's not a loan, but paying back the investment, and the upside is uncapped, really, right? So,
Exactly.
yeah.
Yeah.
Um, um, really interesting. And is that 20% ever negotiated? Like, if maybe this is my very first SPV, do I do a lower carry, 15,
Yeah.
10%, or no?
Yeah, it is often negotiated, and you can even negotiate it on a per LP basis. So you may have look, you may have some friends in the deal that like you don't want to charge 20% to, right? Maybe these are your buddies from high school or whatever, and you're like, no, I'm going to cut them a deal. You can charge them 5%, 10%, charge the rest 20%. How often is it practically negotiated? Not that much, you know. I don't think people are so concerned about how they're going to get 5% more on their money. I think they're more concerned about, will I get any of my money back? And this is going to be a kick-ass deal over time.
Yeah, right. Really interesting. Good stuff. And then there's probably not a single answer to this, but if I want to, eventually raise my own fund, how many SPVs do I need to get under my belt? And do I need to show some distributions first? What are you seeing on people using the platform? Yeah.
Yeah, this is a great question. Unfortunately, there isn't a great answer.
Right, I know.
Yeah, I mean, it really varies. It really varies. It's hard to say. I can't even I'll be pulling some random number out of my cap if we're trying to make something up as far as the number of SPVs. As far as returning money to investors, typically no. Even strong markups can do it. Like if you're investing in a business that you invest at the seed stage and now it's raising a Series D from like great growth capital investors, it's probably going to exit for something in everyone's eyes. And like that's enough to say you can pick winners, right? You don't have to return money necessarily.
Yeah, that makes sense. Totally makes sense. A couple other little minutia on this. Sticking with this same scenario, I find a hot startup. I want to build an SPV and invest in them. Are founders, is the founder of that startup typically willing to give me some time? I guess it's a chicken and egg question, right? Do I need to go find all the investors who pledge to back my SPV first, then I go find a deal? Or do I find a deal and the founder of that startup gives me a month to wrangle all the investors? Do you get the question?
Yeah, typically founders are not as sensitive to the timeline that it will take you to raise money from your LPs. They're more concerned about, hey, and typically SPVs don't lead deals, right? So you're not the lead investor writing the terms for the deal. So the founder is going to be most sensitive to whatever their lead investor and other more sizable investors will want to see happen. And that typically means that the SPV can get in the way of like a really smooth closing. And, we see this all the time. Like it comes down to the wire where someone just needs to close like on June 30th, today, the end of the month, right? And an SPV member might not have funded. And they're like, hey, I'll get my wire in right now, but it still may not make the cutoff, right? So then it's a question like, do you wait for that last check or do you preserve that commitment you made to the founder to like wire? It always comes down to the wire in some of these deals. And unfortunately, SPVs are like a sticky wicket, right? Because there's so many people involved. So I would say for anyone raising an SPV, like make sure you're giving your LPs some lead time, but you're really holding them to like their commitment to wire, and make sure you're not the reason a deal doesn't close, because that's how you just destroy relationships with founders who may not invite you to the next party, right? The next round, which is usually what you're in it for.
Yeah, you've got to get the allocation into the startup, the hot startup, and then you've got to wrangle the LPs and do it all in a pretty tight time frame to be able to get access to the next deal, right? On both sides, you're the middleman making this little market here. I mean,
right.
Again, maybe you don't know this because you're on sort of the back end side, but like, does that new deal originator tell the founder, give me a month, I can do this in a month? Or any sense on that? Like how much time do I need? Yeah.
So, how much time do you need? It really comes down to your LP base.
Yeah.
If you get an opportunity to invest in something and the deal is closing in a month, chances are you're going to go out there and talk to your LPs immediately and be like, look, this deal's closing in a month. I need to know like this week, are you in or not? As far as how fast you can move, I mean, if you're on top of your LPs, like a platform like Sydecar makes it pretty simple, right? We can open your SPV same day. We track all wires and reconcile capital immediately, right? Wires hit instantaneously during a business day. So, we've seen deals close from start to launch in 24 to 48 hours. If you have a very active LP group, most deals take about 30 days to 45 days to close. And that's usually because a company actually pushes out the closing date, right? The company is not holding you to the fire because they're trying to raise more money from around the table also, which gives you more time as the SPV to raise money. But when the company's ready to close, you got to close. So I would say like if you only have 30 days, you got to get on it. Week 1, you got to lock down the LPs. Week 2, you can start to run the SPV. Week 3, you want to get ready to close, so you're not the holdup.
Yeah, really, really good. All right. Shifting gears a little bit here. Describe what is the difference between an SPV and like an AngelList syndicate? Yeah, go.
Yeah, I mean they're practically the same thing as far as what shows up on the company cap table. Now the AngelList syndicate versus like Sidecar, if that's like a question that I might be hearing,
You could be, yeah,
AngelList
you could say
syndicates.
either one. I mean, I guess what's the difference between an SPV and a syndicate? And then,
Yeah,
if you want to add a color, what AngelList is doing, and I know they're kind of a competitor, but that'd be interesting too.
yeah, for sure. No, they're great. So like a syndicate basically is like a group of people, right, that may participate in deals together, right? A syndicate is like the group that invests in something, right? It's a group. It's a syndicate. They're on like the shared mission to do something, right? Now, AngelList syndicates, they built basically a platform that allows you to go subscribe to various syndicates if you're an investor and figure out, hey, like, can I get deal flow? What do these syndicates do? The way that the deal works in the end is they create an SPV for the deal, just like any other SPV. What we've built that's a bit different is we actually have products for syndicates, but our syndicates aren't able to advertise directly through Sidecar, and they don't want to. They want to actually keep some sort of exclusivity and a sense of privacy about like what makes them special from everyone else, and go and meet LPs in the way that they normally are organically, because they find that to be a higher quality relationship. And they also don't want us as a platform to compete with them by offering them other syndicates, right, to their LPs. So we're basically the infrastructure, right, that powers SPVs. And I found that to be a really powerful place for our business to sit.
Yeah, interesting. Okay, a couple other bouncing around a little bit here. I know on your website for emerging managers, you have some other use cases beyond just setting up those deals. One is like the opportunity fund, which is kind of interesting, right? Let's say you've gone on to raise your $20 million fund. Maybe you have a smaller fund for your first fund one. Maybe describe what an opportunity fund is and how you could use SPVs in that to, why would you do it, and what's the value prop there? Yeah.
Sure. An opportunities fund is a fund that typically is alongside your core fund, and it's a fund where you might be able to offer your LPs an opportunity, right, to invest in things that your core fund cannot invest in. Either it's because your core fund has, exceeded its ability to invest a particular allocation. The allocation is more than what your core fund can commit to, or it's outside of your thesis. So you might raise an opportunity fund for like these things that pop up outside of the core fund. Now, typically an opportunity fund is a closed-end fund. It's a committed capital closed-end fund, just like your core fund. So you typically wouldn't use an SPV for a true opportunity fund. You might use SPVs as an alternative to an opportunities fund, where you can have an efficient strategy of creating SPVs for these opportunities without a lot of the hassle and the burden of actually managing a fund. And we see a lot of fund managers doing that with SPVs. So that's kind of the audience you're speaking to there.
Yeah, that makes sense. And I guess if I'm interpreting this correctly, a simple scenario would be I raised a small fund, call it $20 million fund. I've spread 500K checks across a bunch of startups, and maybe one of them is shooting the moon, and I have, rights to reinvest, but
Yeah,
each check gets much larger, bigger than my entire fund. So I want to create an SPV to stay in that deal. Is that a scenario?
exactly. Yeah, right. And this is a tried and true strategy in VC. You gotta reserve capital for your winners, and you want to double down, triple down in those winners.
Yeah, awesome. And then, scout funds too. You have that on the website, which maybe talk about that use case or scenario. What does that mean?
Sure, yeah. So I think that maybe what you're seeing on the website is for our product called Fund Plus. So we actually offer a committed capital fund. This is slightly different from an SPV in that you're raising money to deploy across multiple assets. It's kind of like that fund strategy versus like the SPV strategy. This is like after you've proven your track record, you're raising that fund. We found that that product, is actually quite successful with Scout programs. So what is a Scout program? Scout funds are typically funds that a larger fund, right, that may be focused on, like, let's say Series A companies and beyond, might develop a program to empower those who are at the ground level talking to founders, maybe at the seed stage, to go and write some checks. They might actually seed some capital to these emerging managers and give them an ability to just take capital from the main fund and deploy it into some earlier assets. So let's say the main fund's like a $100 million fund. They might give a couple $1 million to scouts and say, you know what, just go test the waters, go invest 100K, 200K into like 8 to 10 companies that we can be associated with. And if they're successful, we have a relationship with, so they will come to us for their Series A. That's the scout program. Scouts are typically not employed by the main fund. They're just people in network that the main fund believes are in the right areas, having the right conversations with founders, and can successfully deploy amounts of capital behind some cool companies.
Got it. That makes sense. Okay, let's segue into the Fund Plus, which is another product of yours. What else should we learn about that or know about that?
Yeah, look, it's a product that we're excited to bring to the market. It's a product that I believe makes it really simple for someone who's looking at their fund one, raising from friends, family, some family offices, to go out there and just focus on investing and not really worry so much about drafting documentation with very expensive counsel from the get-go and having to worry about all the pain of administration. We basically built a automated fund product that takes care of everything from formation through subscription through the life cycle of fund reporting and tax. And really, it's an all-in-one at a very competitive price point. We have about 80 funds now using that product, and it's gotten really great reception with emerging managers. And excited to offer it, to other use cases like scout programs. Opportunities funds are a good use case for this also, like a true opportunities fund, among other things.
What are all those, you mentioned formation, subscription, tax stuff. That was kind of my next question is, what are all the back-end processes and functions that are included in this? Like, what are you handling, right? We talked about
Right.
it in generic terms, but yeah, go.
Yeah, look, it's a lot. It's a lot that we handle. It's a lot of painful steps for someone to handle manually. So there's entity formation. For creating an SPV or a fund, you got to create the actual entity, right? There's paperwork associated with that to actually draft the document, right? That actually represents the entity, like the actual operating agreement of the entity or partnership agreement. We draft that, we create that via software. There's a whole process of getting your investors to subscribe and commit to something, right? To actually sign agreements to commit to an investment, whether it's an SPV or fund. We create that for each investor, customize it for each investor, depending on the fees that you want to charge that investor to carry that you want to charge that specific investor, which you get to vary. There's banking. For every SPV and fund, we automate the creation of bank accounts. So we can create accounts practically instantly, and we reconcile capital when it hits. So we know exactly who's sending money to the SPV or fund when it hits. We run all the compliance processes to validate investors are who they say they are, so that you are avoiding getting into trouble with FinCEN or dealing with any sort of money laundering or any other efforts that could be in violation of banking regulation. We then create all of the records for your funds. So we manage the portfolio, basically all of the agreements signed with portfolio companies. We help execute, we maintain records for. And then we create the records for the actual fund from an accounting standpoint, so you can report to investors on progress and success in an automated fashion, as well as all the tax filings. It's really full lifecycle support. We don't do a few things, most notably filings with FINRA. If you need to file anything with FINRA, there's this form that you may need to file, but in that case, we point you to counsel that's really efficient to support. But as far as like the fund itself, we practically take care of all the pieces you need to take care of.
Yeah, really interesting. That's a lot. That sounds like a heavy duty, and what, you don't have to give exact number, but what's it cost to start a $20 million fund?
Yeah. So,
yeah.
$20 million fund, it can cost anywhere from about, I think it starts at around $30,000 a year and it scales up from there. That is highly competitive if you compare what we offer versus a traditional manual fund administrator and working with law firms and others to draft the paperwork.
And does that scale as my fund size scales, or does that scale on some other factor?
It scales with fund size. So if you're raising a $100 million fund, it might be a bit more expensive, but it doesn't scale linearly past a certain amount.
Yeah, really cool. That's great. Of the 80 funds using it, are they pretty much all emerging managers, first time funds, second time funds, or have you gotten some more established folks to try it out?
Most are emerging managers. We're really targeting emerging managers for this product.
Yeah. Okay, a couple more questions. I'll let you get back to work, but um, you have a product, or at least it's on the website for founders. Maybe what's the use case for a founder to use an SPV?
So, interestingly, how I mentioned that, if you're an SPV manager, you want to save the founder some headache around like dealing with 30, 40 investors coming onto their cap table. We found that founders have that headache dealing with investors directly, right? So founders want to avoid having investors on their cap table who might commit $5,000 or $10,000, right? Where maybe having to deal with stockholder signatures later and other kinds of resolutions and whatnot. It actually is quite a bit more efficient to have all of your small checks come into one vehicle and then have to just deal with that one vehicle whenever you need consents or for whatever else comes down the pike for managing that relationship with those investors. So that's the product. It's basically an SPV just like any other SPV, except the founder is now the one creating it
Got it.
for
And so
convenience.
there'd be no carry involved. It would just be, hey, I got a whole bunch of small checks that want to come in on my startup.
Correct.
Yeah, very
Correct.
cool. All right. Well, I'll let you go, but we this show is called How I Raised It. We've covered some pretty interesting topic, but how much have you guys raised and over how many rounds?
Yeah, we've raised around $28 million dollars over a number of rounds. So we did our pre-seed in early 21, our seed round in late 21, did a follow-on round a couple of years thereafter because the business was doing really well. And then we raised our Series A late last year.
Awesome. Who led the Series A?
A fund called Decience. They're a fintech-focused firm that focuses on seed and A, and they're awesome to work with.
Decience. That's an interesting
Yeah.
name. Never heard that. Okay. And the pre-seed and seed, did you tap folks from Cooley Network, or did you just have some, you know, people that were? I imagine a lot of people who've been around the venture game would get the problem
Yeah,
you're solving, and therefore
totally.
possibly be investors. How did you kind of pull together seed and pre-seed?
Exactly that way. So pre-seed, many customers invested in us. They immediately got the problem. They were like, "You're building the future of how folks like us will run our businesses. We get it. Take our money." And seed a lot of those folks as well.
Yeah, interesting. All right, that's good enough. Any other tips for either founders or emerging manager VCs, raising capital that you like to share, or if people want to learn more, where should we point them?
Yeah, look, I think building anything, whether it's a company or a fund, it just takes a lot of grit and determination. It can be really easy to jump off the wagon when things get hard. Just stay at it. Raising a fund is especially hard. It just takes a lot of grit, determination, commitment, and you'll get
Are you seeing? Okay, last question. I know I could ask more and more, but
there.
we're recording this middle of summer. What's the market for emerging managers right now? From my perspective, because we sell a product to these folks, like they're really struggling. It's
Yeah.
very hard to raise a fund right now. But are you seeing any patterns, any uptick, any light at the end of the tunnel? What?
Yeah, it's a really good question. We think about this too. For the SPV side of the business, it's still very healthy. The fund side of the business, I think it is harder for managers to raise. That's just the truth right now. I think that we saw that the last few years, there was a lot of deployment into venture capital, and everyone thought that they'd have returns on some time frame that maybe is being pushed out now as companies stay private longer, and many of those companies just won't survive. So that makes it hard for managers to like have built a track record, right, these last few years. And interestingly, I think the year we're in now and last year, some of the best years to invest in because we're seeing like this new technology just take hold and create a ton of opportunity. But valuations are pretty insane, right? So is it a good time to invest? Everyone's still scratching their head. However, the public markets look like they're opening up. So you're looking at like the macro. It seems like some of the indicators that the private markets may remain interesting are starting to turn green, right?
Mm,
Interest rates might drop. There's some signal that the Fed may have a regime change and whatnot. So if that all happens, I think that we'll see that maybe it's a trailing indicator, but I think VC will pick up probably into next year or the year after. But I'm no macroeconomist. These are all just my random thoughts.
yeah. Well, I mean, you are at a unique place in the universe, so I think that's why I asked it, and I think that's interesting. All right, this is great. And then if people want to learn more, it's just where should we point them? It's just sidecar.io, right?
Yeah. So website is sidecar.io. That's SYDECAR.io. I'm on LinkedIn if you want to connect with me directly. And yeah, I love meeting folks who care about what we do and happy to help.
Very good. All right, thanks so much. I learned a ton, and hopefully our listeners did too. So, very
Awesome.
cool stuff. Thank you, Nick. Have a good rest of your summer there in Houston, and stay cool.
Thank you.